Welcome back to the Comm 217 midterm review. We're going to be solving problem 3 of the chapters 2, 3, and 4 review package. So we're going to start off by just reading the required and additional information before we get to the actual problem. So required A, record all the journal entries for the transactions that occurred in January 2015, so journal entries for January. Then prepare the adjusting entries for January 15. Prepare the statement of earnings, statement of financial position, and then the closing entries, followed by some ratios. And they ask you to interpret them as well. For additional info, usually the next place you should look, they give us the tax rate for ABC. That they tell us that the uncollectible receivables are 10% of the outstanding balance. Interest for the month was $25. And they let us know that ABC closes the books on a monthly basis and uses a perpetual inventory system. So this just means that you'll be recording every single inventory purchase and recording cost of goods sold with every sale. So let's read the narrative for the story. On January 1st, 2015, Carly and Carl formed ABC Company, a computer sales and service company, by investing $90,000 in cash. So a lot of people reading this problem may only start recording the entries over here, but that's not the case. You actually need to record from the beginning of the narrative. So when they tell you that cash was invested in the company to start it, you need to actually record that right away. So required A. So cash was received in exchange for issuing shares. So we're going to credit common shares. And that was $90,000. A total of 1,800 shares in ABC were issued, and the shares were split equally among Carly and Carl. ABC also borrowed $10,000 from the local bank. The loan is to be paid in 2018. So it's 2015 now, so this is a long-term loan, so it's going to be a non-current liability. But we are going to record the loan. So debit cash and credit bank loan for $10,000. And we're going to start T accounts for our main accounts, like cash. The interest on the loan is due every 6 months. So that's going to be important for when we do our adjusting entries. So we'll just put AE here to remind ourselves. ABC had the following transactions in January 2015. So January 1st, paid $6,000 in advance for 3 months rent of space for its store. So $6,000 for 3 months. Our monthly rent is $2,000, and so we're going to know that $2,000 is what we're going to have to expense at the end of the month in our adjusting entry. But for now, we're going to just record the prepaid rent. So debit prepaid rent, and that's an asset. And we paid cash, so that's $6,000. Two, purchased office equipment for $5,000 in cash. So we're going to debit office equipment, credit cash for $5,000. Next, purchased 50 personal computers at a cost of $1,500 each. The computers were purchased from supplier A and were paid for in cash. So 50 computers, $1,500 each, so 50 times 1,500 comes out to $75,000. And this was from supplier A, paid for in cash. So inventory, and it's for personal computers, so inventory PC, and we credit cash, 75,000, 75,000. Next, we have 40, we purchased from supplier B on account 50 printers at a cost of $450 each. The terms of the purchase were 210 and 30. So 50 times 450 is 22,500. So inventory, printers, and we're going to credit accounts payable because this was a purchase made on account. So 22,500, 22,500. January 5th, sold 40 personal computers for $25.50 each to a local university. The terms of the sale were 210 and 30, so 40 computers times $25.50 is $102,000. They don't tell you whether it was cash or payables or receivable, but because there's terms of the sale, you know that the sale was not made in cash and that it's a receivable. So we're going to debit accounts receivable, credit sales revenue, and so that was 40 computers, $25.50 each, so 102,000, 102,000, and we're going to make T account for our receivables. So we're owed 102,000, and we're now going to debit cost of goods sold, and we're going to credit inventory PC because that's what we sold. And so we sold 40 units, and if you look here, we paid $1,500 each, so 40 times 1,500 is equal to 60,000. Next, sold on account 39 printers for $750 each to a copy printing store. So 39 times 750 is equal to 17,550. So it's on account, so debit accounts receivable once again, and credit sales revenue for 17,550. And once again, we go to cost of goods sold, inventory, this time it's printers. And so sorry, I put the wrong number here. 39 times 750 is actually 29,250. So we're going to fix that over here on our journal entries. And for our cost of goods sold, that's going to be 39 printers times the 450 we paid for them. And that's going to be our 17,550. January 14th, the local university paid its outstanding balance in full. So let's take a look. January 5th to January 14th is 9 days. And so that is within the 10 days for the 2% discount. And the sale was for $102,000 initially. So we received cash. We're also going to debit sales discount, since we're giving them a 2% discount, and we're going to credit accounts receivable. So AR we're going to debit for 102,000. 2% times 102,000 gives us 2040, and that is our discount that we're giving. And the difference between the two, 99,960, is the cash we're receiving. January 14th, paid supplier B the full balance due. So that's 10 days exactly. So we just made it in time for the discount. So supplier B, we owed them $22,500. So we're going to debit accounts payable to clear the amount that we owed them, so $22,500. We're going to credit cash, and we're going to credit inventory to reflect the discount we got. So 2% times 22,500 is equal to 450. So we're going to credit inventory for that. And the difference is how much we paid in cash. So let's just plug in all the cash transactions we've had. So the last things that we entered into our T account was the $75,000 we paid for inventory over here. So we're going to just fill out the rest of our T account. So we have cash over here, cash over here. So we debit $99,960, credit for $22,050. Next, January 16th, issued 1,000 shares for $50 a share. Carly and Carl purchased the shares in equal quantities and they paid for the shares in cash. So, new share issuance, debit cash, credit common shares. $50 a share for 1,000 shares. 50,000, 50,000. January 31st, employees had earned $12,600 in salaries. So if they tell us that they earned that much, that's how much we're going to have to expense. A portion was paid on January 31st, 2015, and the remaining $3,000 is to be paid during February 2015. So $3,000 is to be paid, so that's going to go into our payables. So let's just fill this out. So debit salaries expense. We know that some was paid, so we're going to credit cash, and some is to be paid. So salaries payable. $3,000 to be paid. $12,600 was earned. So the difference is $9,600, and that's how much we actually paid in cash. Let's just jump to our receivables here. So this $102,000 was settled, and $29,250 was added to our receivables in this transaction over here. Next, a total of $20,000 was still outstanding in accounts receivable. So let's just take a look over here. If you sum up everything here, our AR is at $29,250, and they're telling us our ending balance is $20,000. So the difference between the two is how much we've collected. So that's $9,250. So we're going to record that this was collected. So debit cash, credit AR, $92.50, $92.50. So let's record that in our cash. Dividends of $2,000 were declared. As well, we also have other operating expenses of $8,400 were incurred and paid for during January, and depreciation expense for the period amounted to $1,500. So let's put these down. So debit dividend declared and credit dividend payable for $2,000 each. We also have other operating expenses, credit cash because it was paid for in cash for $8,400, $8,400. And we have depreciation, so debit depreciation expense. And recall, depreciation is never going to be with cash. It's a non-cash expense. Credit accumulated depreciation for $1,500. And now that this is done, we can do our adjusting entries for the period. So let's take a look at what we have. We remember that there's rent to be paid for the month. So we're going to start with that. So required B, adjusting entries. Rent expense, credit prepaid rent. And if you recall, our rent expense was $2,000 per month. For the rest of our adjusting entries, let's look at our additional info. Estimated uncollectible receivables are 10% of the outstanding balance. So what's our outstanding balance? It's $20,000. So we're going to debit bad debt expense, credit AFDA, 10% times 20,000 is equal to 2,000. And we also have interest on the bank loan. So interest expense, it's not paid right away. So we're going to credit interest payable. And let's just go take a look at the terms of the loan. It was $10,000 from the local bank. Interest due every 6 months. And they tell us that the interest on the loan for January was $25. So 25, 25. And finally, we have income tax expense and credit income tax payable. And we don't know what it is right away, but we do know that our tax rate is equal to 30%, so we'll get back to that after. Let's jump ahead to our statement of earnings, fill it out, and we'll come back and we'll fill out the income tax expense then. So, required C. Let's fill out ABC Company. I'm going to fill out the title. Statement of earnings. And this is for the month ended January 31st, 2015. So we have our sales revenue, and if you add up all the transactions, our sales for the month was $131,250 less sales discount, and we gave a discount of $20.40 over the period. So our net revenue is the difference, and that's $129,210. Cost of goods sold amounted to $77,550. And so our gross profit is $51,660. Now we have our operating expenses. So we have salaries, other operating expenses, depreciation, rent, and bad debt. So let's fill this out. Salaries was $12,600. Other operating expenses was $8,400, $1,500 of depreciation, and $2,000 each for rent and bad debt. So if you add these up, that comes out to $26,500, which gives us our operating income, or our earnings from operations, of $25,160. We then put in our non-operating expenses, basically things that are not part of our day-to-day operations. And for us this period, that is interest expense, and that was $25. So our earnings before taxes comes out to $25,160. $135. We can now calculate our income tax expense. So income tax is 30% times 25,135. So that's 7,540, which gives us net earnings of 17,595. And we will now calculate our earnings per share. So EPS, earnings for the period, 17,595. And let's take a look at how many shares we had. At the beginning, we had 1,800 shares. At the end of the period, an additional 1,000 shares were issued, leaving us with an ending balance of 2,800 shares over 2. So our earnings per share is $7.65 per share. Let's just jump back to the previous page and fill out our income tax expense of $75.40. And we are now ready to jump into our balance sheet. So, as with all statements, so for required D, you have to start with the name of the company, so ABC Company. Statement of financial position. And this is as at January 31st, 2015. So once you've netted out all of your T accounts and you've gone through all the transactions, these are the numbers you should get. So you have your assets, current assets. So we have cash, for $133,160. We then put in our accounts receivable less AFDA. So our AR was $20,000, less our allowance for doubtful accounts of $2,000, which gives us a net amount of $1,800. We then have our prepaid rent, and we only have $4,000 left because we used up $2,000 this month. And we have our two inventories. We have our PC inventory, and we have our printer inventory. So our computer inventory is $15,000, and our printer inventory is $4,500. And that gives us our total current assets of $174,660. We then have our non-current assets, and so that is office equipment less accumulated depreciation. So 5,000 less 1,500 is 3,500. And if you add these two together, that'll give you total assets of $178,160. So now we can jump to the other side of our balance sheet, our liabilities and equity. So we have our liabilities, current liabilities. So there's salaries payable, interest payable, dividends payable, and income tax payable. So let's fill these numbers out. You should have them all from solving the problem so far. 2,000 and 75.40. And that gives us our total current liabilities of 12,565. Then our non-current liabilities, we have the bank loan, because if you remember, it was due in 3 years, so it's a non-current liability of 10,000. So total liabilities is 22,565. And we finally have our shareholders' equity. So we have our common shares and we have our retained earnings. Common shares is 140,000 and retained earnings, let's just do our formula. So beginning retained earnings plus net income minus dividends gives us our ending retained earnings. So we had 0 retained earnings to begin with. Our earnings for the period was 17,595 and we paid out, or we declared rather, $2,000 of dividends. So our ending retained earnings is 15,595. So 15,595 gives us our total shareholders' equity of 155,595. And when you add them both together, total liabilities plus shareholders' equity gives us 178,160. And if you look, they balance. So we know we did the problem correctly. We now have to do the next required, which is closing entries. So let's clear off this page over here and we'll fill those out. So required E, closing entries. So the easiest way to do this is to just go to your statement of earnings and just take each line, not the totals, right? So you wouldn't take the net revenue line or the gross profit line, but any line that was a temporary account, you would actually take that and just fill it out from there. So if you go top to bottom, you'll hit everything. And let me show you what I mean. So what we're doing here is we're basically closing the accounts for the period. So equity, for example, an equity account or account like sales revenue normally increases on a credit. To decrease it, we're going to debit it. So we're going to basically close out each account and bring it to a zero balance. So step 1, close your revenue accounts. So we're going to debit sales revenue and credit an account called income summary for the full balance of sales revenue. So 131,250. Step 2, we're going to close our expense accounts. So debit income summary, and we're going to credit all of our expenses. So sales discount was 2040. We have COGS for 77,550. Other operating expenses, 8,400. Salaries expense, depreciation expense, rent, interest, bad debt, and income tax. So we've filled out other operating expenses, 12,600 for salaries, 1,500 depreciation, 2,000 rent, 25 interest, bad debt was 2,000, and 7,540 for income tax. So we're going to debit income summary now by 113,655, which is the sum of the two. And if you look at your income summary account, 131,250, and you debit 113,655, it gives you a credit balance of 17,595, and that's how you know you didn't miss anything, because it's equal to your net earnings of 17,595. We're now going to close that account out, so we're going to debit income summary for 17,595, and we're going to credit retained earnings for the balance. And finally, we're going to take out the dividends out of our retained earnings account. So debit retained earnings and credit dividend declared for 2,000. and the books are closed. So this is basically the journal entries that move all of your income statement accounts into your retained earnings. And finally, we have to do our ratio analysis. So we're going to clear off this page and we're going to do our ratios. So required F, ratio analysis. So let's look at the required. So they ask us to calculate the current ratio, net profit margin, and return on equity ratios. And they ask us, what does this tell you about, what do the results tell you about ABC company? So we're going to start off with our current ratio. And that is equal to current assets over current liabilities. So that is 174,660 over 12,565. So that gives us 13.9. So what does this tell you? For every $1 of current liabilities, ABC has $13.90 of current assets. Shows they are very liquid, meaning that they are very able to pay off all their short-term debts. So very liquid and can easily pay off short-term liabilities. And we could also say they have a lot of current liabilities. If you look at their balance sheet, they have $133,000 of cash, which is the bulk of their current assets. So we could say maybe they are not being efficient with regards to their current assets. They could be using their assets more efficiently because all that cash is just sitting there. Next, we have our net profit margin. So that is equal to net earnings over net revenue. So that is 17,595 divided by 129,210, which is 0.1362, so 0.14. So what does that tell us? For every $1 in net sales, ABC earns 14 cents in net income or in profit. And in order to interpret whether this is good or bad, we should compare to competitors or industry average. We don't know if this is good or bad, really. We need to see what's normal for the industry. And finally, we have return on equity. So that is net earnings over average shareholders' equity. So at the beginning of the period, it was 90,000 because that was the initial investment. And if we look at the balance sheet, our ending equity was 155,595. So net earnings for the period was 17,595 and 90,000 plus 155,595 divided by 2. So that gives us 0.1433, which is 0.14. So this shows us for every $1 invested by shareholders ABC shows net profit of 0.14, and once again, if this is good or bad, compare with either 3 competitors or industry average. And so that's it for our problems for chapters 2, 3, and 4. We hope you join us in the problems for further chapters for this midterm review.